Hello friends, DK this side. When we do the fundamental analysis in the stock market, the primary aim is to find the soundness of the business in which we wish to invest in. In order to find out whether the business is sound or not, we check various financial ratios to understand the overall health of the company, future growth forecasts of the company, and valuation of the stock at the current market price. So in this video, we will check one of the very important financial ratios, that is price to book ratio, which is basically a ratio which measures the valuation of a stock at the current market price. So friends, don't forget to like the video, subscribe the channel, hit the notification bell for updates. Let's begin. What is price to book ratio? Sometimes it is referred in short as PB ratio. So it is a financial ratio that compares the company's stock price with its book value per share. That is the definition of the price to book ratio. Now, how this is calculated? The calculation is pretty simple. It is calculated by dividing the company's market capitalization by its book value. So there are two elements in calculation that is involved in calculating the price to book ratio. What are those two? Market capitalization and book value. So let us understand one by one each of these two. Simply to put forth, the book value of a company is the difference between its assets and liabilities. It is essentially the amount of money that would be left over if the company were to liquidate all its assets and pay off all its liabilities. So the difference would be left out. Now we have understood one of the two elements of the price to book ratio. Now let us understand what is market capitalization. Simply to put forth, market capitalization is the total value of the outstanding shares. How it is calculated? Outstanding shares multiplied by the current market price of the share will give you the market capitalization of the company. The moment we know the market capitalization and book value of the company, which are the two elements to arrive at price to book ratio, now it becomes very simple. You divide the market capitalization to the book value, you get the price to book ratio. Now, since price to book ratio compares with the current stock market price with respect to the book value of the company or book value per share of the company, which means higher the book ratio, more expensive is the stock, lower the book ratio, less expensive is the stock. So price to book ratio may help us to understand the valuation of the stock at the current market price. Let us understand price to book ratio with a simple example to understand PB ratio. For example, a company has a market capitalization of 100 million rupees. And the book value of that company is 50 million rupees. So 100 divided by 50 will give us a figure of 2, which means price to book value stands at 2, which indicates that the stock currently is trading at twice its book value. However, the PB ratio or price to book ratio is just one metric that the investors should consider when they are doing the evaluation of a stock. Other factors such as the company's earnings, growth forecasts, or growth prospects, the financial health should also be considered while evaluating a stock. In general, a PB ratio of less than 1 is considered to be undervalued, while the PB ratio of more than 3 is considered to be overvalued. This is merely a guidelines, or you may call it the thumb rule. However, these are just being merely a guideline or a thumb rule. PB ratio should be understood in context of the specific company and also the industry in which the company is doing its business. Here are some of the factors that can affect the PB ratio. Number one, company's age, younger the companies typically have the lower PB ratio than older companies because they have not had much time to accumulate the assets. Number two, companies industry in which the company is doing the business. Some industries such as technology space tend to have a higher PB ratio than the industries which are operating in utility sector. Third, the company's financial health. Companies with stronger financial health typically will have the lower PB ratio than the companies with weak financials. Number four, the companies having a higher growth forecast. The company with a higher growth forecast will typically have the higher PB ratio in comparison to that of companies which have a slower growth forecast in the future. By now, you must have understood that the PB ratio is a useful tool to evaluate a stock, especially with respect to its valuation at the current market price, but it should never be used in isolation. Other factors such as companies' earnings, future growth possibilities, and the financial health of the company should also be considered along with the other valuation metrics such as price to earning ratio, price to sales ratio, or comparison of the current market price with respect to the fair value price or intrinsic value. I hope, friend, this small tutorial might have given you the fair idea about the price to book ratio and its calculation. Give a lot of thumbs up to this video, share this video, subscribe the channel, hit the notification bell for updates. Looking forward to meet you very, very soon.